Chart patterns are your roadmap in the world of trading. They are visual shapes that appear on price charts. These shapes are formed by the price movements of stocks, currencies, and other assets. Think of them as stories told by the market. They show the struggle between buyers and sellers. By learning to read these patterns, you can get a better idea of where price might go next. It's like learning to read the weather before you go sailing. You can prepare for potential storms or enjoy the sunny skies. This knowledge helps you make more informed decisions instead of guessing. Understanding chart patterns gives you a significant edge. They don't predict the future with 100% certainty. However, they do provide clues about what is likely to happen. These patterns have been observed over many years and tend to repeat. When you see a familiar pattern, you can anticipate a move and plan your trade. This is much better than trading on emotion or rumors. It gives you a structured way to find opportunities based on historical price action. There are two main types of patterns you will encounter. Continuation patterns. After a brief pause, the price keeps moving in the same direction. Reversal patterns. Signal the current trend is about to change. For this chapter, we focus on continuation and bilateral patterns, those that can go either way. Learning these will give you a solid foundation and confidence. Before you trade based on a pattern, have a plan. The plan has three key elements: the entry price, the stop loss, and the target price. The entry price is where you buy or sell. The stop loss protects you from large losses. The target price is where you take profits. Defining these 3 points separates disciplined traders from gamblers. Let's start with a common continuation pattern, the bearish flag. Imagine a tall flagpole pointing down. This is a sharp, strong price drop. After the drop, price bounces within a small, upward slanting channel. This channel looks like a flag attached to the pole. Sellers are just taking a short break. Once price breaks below the flag's bottom line, it often continues down. For example, a stock drops from $50 to $40 quickly, then trades between 41 and 43, a bearish flag. To trade a bearish flag, plan your entry just below the lower trend line to confirm the breakdown. Example, entry, flag bottom $41, enter at $40.90. Stop loss, just above the upper trend line. Example, stop, $43.10. Target, measure the flagpole height. If the pole was a $10 drop, you would project another $10 drop from your entry. Example, target, $30.90. Now the bullish cousin, the bullish pennant. It's the opposite. Signals continuation upward. It starts with a sharp, explosive move up, the pole. After the jump, price consolidates into a small, symmetrical triangle, the pennant. Buyers pause and regroup before pushing higher. Example, surge from $100 to $120, then trades between $118 and $121 for a few sessions. Trading a bullish pennant is similar but flipped. Entry, just above the upper trend line to catch the breakout. Example, entry, $121.10. Stop loss, just below the lower trend line. For example, $117.90. Target, add the pole height to the breakout. Example, $141.10. Another powerful bullish continuation pattern is the cup and handle. As the name suggests, it looks like a teacup on the chart. The cup is a U-shaped price movement, a gradual decline, then a gradual recovery back to the previous high. This U-shape indicates consolidation and a solid bottom. After the cup, a smaller downward drift forms the handle. The handle is a brief consolidation before a likely move upward. Imagine a stock trading at $80, dipping to $70, then climbing back to $80. This creates the rounded cup. Then it might dip to $78 for a week, forming the handle. The pattern is considered reliable because of selling pressure. Then buyers regain control and push to new highs. The longer and more rounded the cup, the stronger the signal. Trading this pattern requires patience. Entry is typically just above the handle's resistance. If the handle's high is $80, you might place a buy at $80.50 to confirm the breakout. Place the stop loss below the handle's low, for example, $77.50. Measure the cup depth from bottom to rim and add it to the breakout level. If cup depth was $10, target would be $90.50. On the flip side, the inverse cup and handle. It's a bearish reversal signaling a potential downtrend. An inverted U-shape, then a small upward bouncing handle. When price breaks below handle support, it often triggers a sharp decline. Buyers tried to push up but failed. Sellers take control and can drive price much lower. Cup and handle, and its inverse. Know the rules and trade the plan. Define your entry, stop loss, and target before you trade. Set orders on your platform and obey your plan. Risk management is the core of responsible trading. Triangles are another common family of patterns. They show a pause in the current trend. First, the ascending triangle, a bullish pattern in an uptrend. It looks like a right-angled triangle on your chart. The top line is flat. A resistance level price struggles to break. The bottom line is rising. The price makes higher lows. This shows buyers are becoming more aggressive. A breakout to the upside becomes more likely with each test. For example, if a stock hits resistance at $30, its lows progress, $27, $28, $28.50. The setup is clear. Your entry would be just above resistance, say $30.10. Stop loss could be below the last higher low, for example, $28.40. Target is estimated by measuring the widest part of the triangle and adding it to breakout. If the height is $3, target around $33.10. The opposite is the descending triangle, a bearish pattern. Here the bottom line is flat, a support level. The top line descends. Highs are getting lower. Sellers are getting more aggressive. A breakdown through support often leads to a sharp decline. Imagine EURUSD finding support at 1.2000. Its highs fall. 1.2150, 1.2100, 1.2050. Sellers gain control. This signals a likely downward move. Finally, the symmetrical triangle, a bilateral pattern. It can break out or break down. Either way is possible. Two trend lines converge. Price range gets tighter until a decisive move. A breakout above signals uptrend, a breakdown below signals downtrend. Knowing these patterns helps you set entry, stop loss, and target with clarity. Set your entry on the platform. Place your stop loss, and define target levels. Trade with a clear plan.